Hey guys, so welcome back to the channel. Today I have another day trading strategy which I'm going to backtest for you over 100 trades. I will first tell you about the indicators we're going to be using, show you a few examples, and then I'll perform the 100 trade backtest. So this trading strategy involves one trading indicator, and it's the exponential moving average. So the exponential moving average is a sort of moving average that gives the most recent data points more weight and relevance. The exponentially weighted moving average is another name for the exponential moving average. The EMA reacts more strongly to recent price movements than a simple moving average, which gives all of the observations in the period identical weight. So this backtest is based on the 1 hour time frame with a minimum of 1 to 5 risk to reward ratio. So that means that every dollar that we risk, we aim to make a minimum of $5. So here's the strategy. We go long and short every time the price crosses the 200 EMA, regardless of the direction, and we place both stop losses to the closest swing. There is no maximum number of trades that we can have at any given time, and as soon as the open profit is equal to the maximum risk that we are taking per trade, we move the stop loss to break even. And the last rule is that we must have a 1 to 5 risk to reward ratio. So let's get on the charts now so I can show you a few trades, and then we'll dive into the 100 trade backtest. So here we are on the charts on GBP USD on the 1 hour time frame. We'll go ahead and add the exponential moving average. So I've got it saved up here, moving average exponential. We're going to change the settings to 200 and the method to EMA. And we'll change color to light gray, slightly thicker. So essentially every time that the price crosses the 200 EMA, so that white line, we go long and short, and we place the relevant stop losses at the last swings in either direction. So essentially you would go long, the last swing being here, and you would aim for a 1 to 5. But also you would go short at the same time. You could either put your stop loss here or right here, but either way, you would have been stopped out. And this long trade, let's see if you would have made a profit from it after a few days, perhaps. You would have been stopped out here, but then you would go short and long here at the same time with the stop loss at the last swing, and then this would have been a win. So I'll show you a few examples now, and then we'll dive into the backtest. So here's a pretty good example. The price breaks the 200 EMA here, so we go long, we place the stop loss right here, and we aim for 1 to 5. Obviously this is a loss. However, that short trade, the stop loss is at the last swing, and it gets hit after a couple of weeks, so that's about a month. And essentially what's really interesting is that all of those short trades within that month would have resulted in 1 to 5 successful trades. Obviously we would have had a few losses from the long trades, but in trending markets like so, the results can be quite impressive. So let's get on the backtest, and I'll see you for the results. All right, so here are the backtesting results on the GBP USD instrument. We had a maximum drawdown of 37%. We were risking 5% per trade, and we had a 1-to-5 risk to reward ratio. We had a total of 12 wins, 40 losses, and 48 trades that resulted in break even. We had a maximum of 1 win in a row and a maximum of 6 losses in a row. That gives us a win rate of 23% over 126 days. So the total profit is still positive. We are at 146.6%, which means if you had started with $10,000, you would have ended up with $14,656. So we are still in the green. However, the drawdown and the volatility are pretty high compared to the profits. I'm pretty sure we can improve this strategy by taking a higher time frame, or as you may have seen in the backtest, it got pretty messy, so there's a lot of different trades. Perhaps we could limit the number of trades that we have at any given time, perhaps a maximum of 1 long and 1 short at a time, perhaps on a higher time frame, so that will result in less trades, however bigger moves. So let me know what you guys think, and I'll see you in the next video.